exactly 48 hours, a single man trading from his living room wiped out 2/3 of an entire European exchange's default fund. We are taught that systemic financial risk wears a suit, that it originates in the megabanks of Wall Street. But in September 2018, the Nordic electricity market was pushed to the absolute brink of systemic collapse by a quiet, secretive trader in southern Norway. This is the anatomy of a 10 sigma market event. It's a masterclass in how institutional risk models are fundamentally blind, how a mathematically brilliant portfolio can bleed to death, and why the most dangerous weapon a trader can possess is the absolute absence of financial fear. To understand how one individual could threaten a multi-billion euro system, you have to understand a psychological anomaly. Einar Aas wasn't a quantitative genius at Goldman Sachs. He started at a standard desk in a regional utility company. But he possessed a trait so rare, it borders on the neurological: absolute risk indifference. While normal traders panic during massive drawdowns, he viewed capital simply as ammunition. Over 15 years, he leveraged this trait to become the biggest, most secretive energy trader in Europe. He was so intensely private that despite his massive wealth, only 2 confirmed public photographs of him even exist. No interviews, no public statements, just a ghost moving billions from the shadows. And he didn't operate from a glass tower in London. He built his empire from massive screens inside this isolated coastal mansion in his hometown. But unlike the ruthless Wall Street stereotype, the few who actually knew the ghost described a very different man. Behind the screens, Aas was a quiet benefactor, pouring millions of his private profits into local sports and charities. He was fiercely loyal to his tight-knit inner circle, but to play that massive game from his living room, he had to make a terrifying calculation. In modern finance, your ultimate hedge isn't a derivative, it's the corporate veil. The limited liability company exists to build a firewall. If a fund blows up, the fund dies, but the manager keeps his house. Einar Aas didn't use a firewall. He traded his massive portfolio as a private individual with infinite, absolute, personal liability. Why absolute secrecy? If he registered a company, Norwegian law would force him to publish his financials. His giant, state-owned competitors could reverse engineer his margins and squeeze him out. To ensure his portfolio remained a complete black box, he bought absolute regulatory secrecy and paid for it with infinite personal risk. So, what was the exact trade that broke him? It was a massive geographic spread. And full disclosure, I know exactly why he put this trade on. Because I used to trade this exact same spread myself earlier in my career, and it was highly profitable. To understand the logic, you have to look at the physical grid. The Nordic market revolves around a benchmark called the system price, a theoretical index representing the entire region, structurally driven by rain, snowmelt, and massive hydro dams. Germany's grid, on the other hand, was heavily dependent on dirty coal, gas, and European carbon emissions. But why bet heavily against Germany and on the Nordics? Because of a mathematical edge. Published academic research shows a structural anomaly. German winter futures consistently overprice risk. The actual physical spot electricity usually ends up delivering much cheaper than what the paper contracts predicted. Sellers extract a massive risk premium. The Nordic market does not have this consistent bias. However, in winter, demand increases massively in the Nordic, so the amount of electricity ready for export is often limited. This means that to avoid exporting too much electricity, the Nordic prices must increase to the German level in a certain amount of hours of the day, no matter what the German price is. So, by systematically shorting German winter contracts and going long on the Nordics, Aas wasn't just gambling. He was harvesting a structural risk premium. The trade started with a mathematically positive expected value. Furthermore, these two distinct markets are physically connected by massive transmission cables. Because electricity flows from where it's cheap to where it's expensive, these cables act like a physical rubber band. If German power gets too expensive, cheap Nordic hydro flows south, pulling the prices back together. They heavily correlate. And here is the fatal flaw in the institutional system. Because of this historical correlation, NASDAQ's value at risk models viewed this spread as low risk. If you hold a long position in one correlated market and a short in the other, the exchange gives you a massive discount on the cash collateral you have to post. A positive expected value combined with a margin discount allowed Einar Aas to leverage up to a staggering scale, up to 2,500 megawatts on the quarterly contracts alone. He didn't just participate in the market, he essentially was the market. He was one of the main buyers of production hedges in the entire Nordic system. When it all collapsed, the media called it an unpredictable black swan. That is a lie. The clearinghouse, NASDAQ, knew. A full year earlier, NASDAQ realized his position at the time was a systemic threat and secretly forced him to downsize. But then, they let him go right back to business as usual, trusting the exact same flawed risk models. Models entirely blind to the physical limits of the grid. Amateurs think traders go bankrupt because their prediction is wrong. Professionals know you go bankrupt from margin calls while waiting to be right. John Maynard Keynes famously said, "The market can remain irrational longer than you can remain solvent." Summer 2018. Northern Europe suffers a historic drought. Hydropower dries up, and short-term electricity prices surge. Aas was holding short positions on the short-term delivery contracts to hedge his massive long positions further out on the curve. Because of the drought, the market moved against him every single day. He suffered an agonizing liquidity bleed, forced to wire millions in precious free cash to NASDAQ daily, just to cover his variation margin. By September, his cash buffers were virtually drained. Ironically, his main long-term spread was structurally sound and actually profitable. But he had no way to take profit. The market was simply too illiquid to absorb his massive size. He was trapped. And then, the sky opened. Mid-September, the Whipsaw Effect. Massive sudden rainfall violently crashed the Nordic system price. His long positions were crushed. Simultaneously, European carbon emission quotas exploded, shooting German power to the moon. His short positions were obliterated. What the historical value at risk models fail to calculate is that physical cables have a maximum capacity. When transmission maxes out, when hydro reservoirs in the Nordic market fills up and struggles to welcome new rain, the markets decouple. The physical rubber band violently snapped, a force that NASDAQ's risk models deemed mathematically impossible, a 10 sigma event. NASDAQ issued a catastrophic margin call for 114 million euros. But the summer drought had left his cash reserves empty. The liquidity was gone. The personal firewall didn't exist. He was officially in default. For 15 years, Einar Aas had been a ghost in the financial system. But as his empire collapsed, the ghost was forced to break his silence. Alone in his house, he released a devastatingly precise, real-time financial obituary.
On Monday, September 10th, there were extraordinary price movements in the Nordic and German power markets. I have held too large a position relative to the liquidity in the market, and during Monday, the last 350 million of my free liquid assets were transferred. This was not sufficient to cover the loss, and on Tuesday I was therefore placed under administration by the NASDAQ exchange. On Wednesday evening, my entire portfolio was forcibly liquidated by NASDAQ, resulting in a massive personal loss. The consequence of this is debt settlement or personal bankruptcy.
For the trader, the nightmare ends with personal bankruptcy. He lost the wealth he had built for his community. But for the clearinghouse, it had just begun. Aas left a gaping hole of 114 million euros. The bill had to be paid immediately or the system would collapse. And this is where the true scandal of clearinghouse risk is exposed. How much skin in the game did NASDAQ actually have to cover the disaster they had allowed to happen? A pathetic 7 million euros. The remaining 107 million had to be drawn from the mutualized default fund, a safety net paid into by every other innocent participant in the market. In 48 hours, over 2/3 of the entire commodity default fund was wiped out by one man. Contagion had arrived. Innocent utility companies who had hedged perfectly safely suddenly received massive bills to cover their competitors' extreme size. Furthermore, NASDAQ ordered all members to inject another 100 million euros within days, just to keep the exchange alive. To stop a systemic meltdown, NASDAQ had to hold a secret, desperate fire sale outside opening hours, forcing competitors like Vattenfall to step in and swallow the radioactive portfolio at a steep discount. Einar Aas built an empire on a mathematically sound risk premium, but lost it to physical grid limits and an extreme liquidity bleed. But the true systemic failure belonged to the clearinghouse, trusting outdated historical value at risk models to predict a violently changing future. In the end, his positions the following winter, in particular, and the following year, were highly profitable for whoever ended up taking them. But this is of little help when margin calls.